Silver just did something it almost never does quietly. In less than a year, the price of silver nearly tripled, briefly pushing past $80 an ounce. This surge did not happen in a vacuum. It happened while technology stocks stalled, while artificial intelligence valuations began to wobble, and while investors quietly rotated out of growth and into assets designed to survive instability. So the question is not simply why silver is rising. The real question is this: when silver moves like this, what does it break next? To understand why this moment matters, we have to understand why this rally is different from every silver rally that came before it. Silver has surged in the past. It spiked during the inflation panic of 1980. It surged again after the global financial crisis in 2011. But those moves were driven by fear and speculation. This one is driven by structure. At the start of 2025, silver traded near $29 an ounce. By December, it surged above $70 and briefly peaked near $83. That represents a gain of roughly 180% in a single year. Silver did not just outperform stocks, it outperformed gold. That should make markets uncomfortable. Silver is not supposed to lead, it is supposed to lag. When silver breaks that rule, it usually signals that something deeper is changing beneath the surface of the global economy. The silver market is facing a problem that cannot be solved quickly. The world is consuming more silver than it produces. Global mine supply sits just above 800 million ounces per year. Global demand now exceeds 1.1 billion ounces. This imbalance is not new. For 5 consecutive years, the silver market has run a structural deficit. To fill that gap, the world has been drawing down above-ground stockpiles. Those stockpiles are now dangerously low. COMEX warehouse inventories are down roughly 70% since 2020. London and Shanghai vaults are near historic lows. There is no buffer left. This is not a paper shortage, it is a physical one. When prices rise under these conditions, they do not rise smoothly. They jump violently. For most of history, silver played 2 roles. It was money and it was ornament. That era is over. Today, silver is an industrial metal first and a precious metal second. Silver is the most electrically conductive metal on Earth. Modern civilization is built on conductivity. Silver now sits inside solar panels, electric vehicles, power grids, data centers, semiconductors, and artificial intelligence infrastructure. Every server rack, every electric motor, and every renewable energy installation relies on silver to move electrons efficiently. One estimate suggests that solar energy alone could consume up to 40% of global silver supply by 2030. Artificial intelligence does not exist in the cloud. It exists in physical machines that consume electricity and generate heat. As artificial intelligence scales, silver demand scales with it. Unlike jewelry demand, industrial demand does not disappear when prices rise. It absorbs the cost. This structural demand collides with geopolitics. China refines more silver than it mines and sits at the center of global electronics and solar manufacturing. In late 2025, Beijing announced new export licensing requirements for processed silver beginning in 2026. Markets reacted instantly. That announcement sent a clear signal. Silver is no longer treated as a neutral commodity. It is being treated as a strategic resource. Russia has announced plans to add silver to its reserves. The United States has quietly designated silver as a critical mineral. Once governments begin hoarding, markets stop functioning normally. Trade becomes political. Pricing becomes unstable. Silver has stopped being neutral. This shift helps explain why silver surged at the same moment technology stocks began to stall. In December 2025, while silver and gold hit record highs, global equity indices weakened. Artificial intelligence leaders pulled back. Volatility crept in. This was not coincidence, it was rotation. When investors feel confident, they chase growth. When confidence cracks, they buy insurance. Silver is not a growth asset, it is a stress asset. Historically, periods of silver outperformance coincide with equity drawdowns, tightening liquidity, and rising macro uncertainty. Silver does not crash markets. It rises because markets are already under pressure. There is another risk hiding beneath the charts. Silver is embedded in nearly every modern supply chain. When silver prices double, costs ripple outward. Solar panels become more expensive. Electric vehicle margins compress. Electronics manufacturing tightens. At first, companies absorb the cost. Eventually, they pass it on. Silver does not merely reflect inflation. It contributes to it. That puts central banks in a bind. Cut rates to support growth or tighten policy to contain cost-driven inflation. Either path pressures equities. This raises the most controversial question of all. Is silver in a bubble, or is it being repriced? Some analysts argue this move is speculative mania. Others argue silver spent decades undervalued. The truth is uncomfortable. Silver was priced for a world that no longer exists. For years, silver traded as if supply was flexible, industrial demand was optional, and monetary instability was temporary. None of those assumptions hold anymore. That does not mean silver cannot correct, it already has. But corrections do not fix shortages, they delay them. Silver does not predict crashes, it confirms stress. If silver stabilizes in the $60 to $70 range, markets may calm. If silver resumes its climb toward $100, it likely signals that inflation pressures are returning, financial confidence is weakening, and capital is preparing for volatility. Silver acts like a thermometer, and the temperature is rising. To understand why silver behaves this way during periods of stress, it helps to view it not as a single asset, but as a bridge between two worlds. Silver sits at the intersection of money and industry. Gold reflects fear and monetary distrust. Copper reflects growth and industrial expansion. Silver reflects both at the same time. This dual identity makes silver unusually sensitive to regime changes. When growth is strong and inflation is low, silver underperforms. When growth slows but industrial demand remains firm, silver tightens. When monetary systems weaken while physical demand stays elevated, silver explodes. That is the environment emerging now. Debt levels across the developed world are historically high. Governments rely on low interest rates to remain solvent. Energy systems are being rebuilt in real time. Artificial intelligence is accelerating electricity demand faster than grids were designed to handle. And geopolitical fragmentation is replacing globalization. Silver absorbs pressure from all of these forces simultaneously. Unlike oil, silver has no strategic reserve that can be released quickly. Unlike copper, silver production cannot scale rapidly because most silver is mined as a byproduct of other metals. Higher prices do not immediately translate into higher supply. This creates a dangerous feedback loop. Rising prices signal scarcity. Scarcity encourages hoarding. Hoarding tightens supply further. Prices rise again. Markets are only beginning to price this reality. For decades, silver was treated as excess. Vaults were full. Demand was predictable. Today, inventories are thin, and demand is accelerating in sectors that cannot substitute easily. This is why sudden silver spikes tend to unsettle equity markets. They reveal stress that traditional indicators often miss. Bond yields can be distorted by policy. Stock prices can be supported by liquidity. Silver cannot be printed. That is why silver moves violently when systems are strained. If this silver surge fades quietly, it will likely mean supply responded or demand slowed. If it does not, the implications extend far beyond one metal. It suggests a world where physical constraints are reasserting themselves after decades of financial abstraction. In that world, volatility becomes normal. Planning horizons shorten, and markets become more sensitive to shocks. Silver is not the cause of that shift. It is the signal. And signals like this rarely appear without consequences. History shows that moments like this are rarely resolved quickly. Price stability returns only after imbalances are corrected, either through increased supply, reduced demand, or economic slowdown. None of those forces move fast. That is why silver matters now. It compresses years of stress into price. It reacts before balance sheets break and before headlines change. It forces markets to confront reality sooner than they would like. Silver does not offer comfort, it offers clarity. And clarity in unstable systems is often the most unsettling signal of all. Investors ignore that clarity at their own risk because when signals are dismissed long enough, adjustments arrive suddenly, without warning and without mercy, reshaping portfolios, industries, and entire economic narratives in a single violent transition across global markets and institutions. simultaneously in unpredictable ways globally today.